Thank you very much for inviting me to speak about the oil and gas markets today from Norway. So, how do we see things? First of all, to explain the context of the oil price. Oil prices have historically always been volatile and cyclical. Here we are looking at a chart of the oil price, Brent, from 1990 to date. And as we can see, it has shown a lot of volatility in even periods of extremely high prices at above $140 and extreme lows. In the case of WTI, of even negative oil prices last year following the COVID-19 oil demand shock. So what does this mean? This means that we have periods where we have high oil prices because we have demand exceeding supply, which then stimulates a lot of investment into the sector. The sector then invests, typically overinvests. It takes about 3 to 5 years for those investments to come into the market in terms of oil barrels of supply. And then we see prices come down, thereby cutting investments as we enter that part of the cycle. This continues until we then again see supply falling short of demand, and then we start to have price increasing again, stimulating investment. And so it goes on the way it has always gone on. Now, when we look at the last 10 years, here we're looking from around 2010 to date, so a bit longer, what we saw is that in 2011 to 2014, we had quite high, stable oil prices. And what that did is it created a long period of high oil investments. That then led to a price collapse the following years because of this overinvestment in supply. Since then, we had been on a stage of recovery for oil prices until COVID-19 hit, thereby killing off demand and then causing investments to collapse. Now we've had demand increasing again as the world has started to become more normal, more mobile, more open. Yet we have not seen that level of investment. Here we are looking precisely at the investment side of things. This is showing global E&P companies investing in oil and gas. And as I explained in the previous chart, through 2014, we had enormous investment, approaching $900 billion. When we compare that to where we are today, we're at less than half of that. We're only slightly above $400 billion. When we look at next year, we expect the investment level to be even lower. Now, that's despite the fact that we've been trading at oil prices of above $80 versus 2020's prices and the $20 to $30 range. Now, why is that? It is because the oil market is changing and the world is changing. Part of it is that the market doesn't expect demand to recover the way it has in the past. Here we've added in global demand into the chart. Those indicate the bars. What you can see is that we had a peak in 2019 and then a collapse in 2020 for oil demand. 2021 has now shown quite a strong comeback, and 2022 is forecast to exceed even 2019. In the meantime, we've had an energy transition boom. We've had a lot of investment in renewables, and this is making the market expect that perhaps we will not grow in terms of oil demand the way we had anticipated pre-COVID, and therefore we do not need so much supply. However, the market is overdoing it. We are having such a collapse in investments that we are having a huge shortage in supply, and we will continue to have the shortage in supply against demand. When we look on a quarterly basis on what has happened since COVID, we're starting here in the first bar. We are looking at the first quarter of 2020. So when COVID was first officially announced as visible in China. We had enormous inventory bills for the first 2 quarters of that year, but already in the 3rd quarter of last year, we started to have inventory draws, and that is because China had started to come back to the market. Life there was normalizing, while life in Europe and in the US and North America, South America was only starting to head into lockdown situations and more difficulties. So what we see is that actually we have 9 quarters of stock draws. So those stock draws continue through the third quarter of next year. Now, it may appear that, well, we need these stock draws because we had such an enormous stock build and we weren't in such a high price oil environment. But in the next chart, we'll look at the state of where oil inventories are in a historical context. In the first bar, we're looking at the 5-year average of OECD oil and product stocks. Products include gasoline, diesel, and so forth that we need for our economies and our daily life. And then we show on a quarterly basis through the second quarter of this year how the stocks have first built. So Q1, Q2 of last year, stocks built. And then starting with Q3, we've had stock draws every quarter. We had a slight build in July, and then we've had draws in August and September. So now we are well below the 5-year average in terms of OECD oil inventories. Yet we expect 4 more quarters of stock draws. So this builds a very bullish price environment. But as we showed in the previous chart, we don't see E&P companies moving on that. They're not investing. And this is because of investor pressure. Investors are uncertain that we will need oil going forward. E&P companies are focusing on short-term investments. They're looking at existing acreage near existing facilities. We see companies like Equinor looking at things that are very near their existing acreages so that they can electrify the platforms, do it in a more renewable, sustainable way. And this is absolutely changing the way the oil market works. They're also trying to find the cheapest finds. But at the same time, when you're electrifying, that doesn't happen for free. So this is where we're having a real sea change in the market. Now, when we look further on the demand side, well, do we still need oil? Let's look at what has been happening in terms of gas. European gas inventories are extremely low right now. And no doubt you've noticed this in terms of electricity prices, in terms of gas prices, and natural gas prices across Europe. Now, what this chart is showing is in the light blue shading, that's the range of the 5-year inventories in European gas. The bright blue shows the peak of inventories, and that was especially built up during COVID, although the end of 2020 showed a very cold winter in Russia, in Japan, and that actually impacted European gas inventories. This year, we never built them up in the first place. Why is that? It's because there's been a transition away from nuclear power and a transition that was planned away from coal. Yet, and also, we had a huge buildup in wind capacity and solar capacity in Europe, especially in Germany. Unfortunately, the wind didn't blow enough. There were not enough sunny days for us to actually have enough power produced from these renewable sources. So we've had to turn to gas to help power Europe. Especially, we saw this already in September, and September is not a seasonally cold month. So this is where the entire energy transition still depends on gas, and it still depends on oil. Now, when gas inventories are this low, we have to turn to the oil market in order to fulfill that demand. So this is just showing short term that the market underestimates oil demand growth. We show what the market thinks in the International Energy Agency in the dark blue bars, and then our expected demand on top of that. At the same time, non-OPEC supply is lacking pre-pandemic levels. You can see from the light blue bars that we have much lower supply. That's the history. So we had much higher supply then than we have now going forward. And then when we look at OPEC supply, it's far, far beneath those levels. And that is in terms of a plan, because they want a tight market, because they need to stimulate investment. Investment is not coming into OPEC countries or into the OPEC national companies. So what does that mean for oil prices? We actually expect a high oil price environment to continue now. We've raised our long-term oil price forecast to $70. And when we look from 2025 to 2030, we actually expect the oil price to overshoot $70 quite a lot for a period of time. Now, we will have likely already have seen peak demand by then, but because we are not ready to only rely on renewables and gas to fulfill that gap, we still need to have oil investment for the economies to run well. Thank you.